Hi guys, welcome to my channel. Before we get started, make sure to hit that like button. Also subscribe to my channel. The psychology of investing, how emotions affect our decisions. So make sure to watch the full video. Introduction. Investing is a complex process influenced by both financial market knowledge and our own emotions. Understanding the psychology of investing is crucial because emotions often shape our investment decisions, leading to biased choices that can have a detrimental impact on our financial well-being. In this blog, we will delve into the intricate relationship between emotions and investing, exploring various psychological factors and strategies to overcome biases. 6. The role of emotions in investing. Emotionally driven decisions. Emotions play a significant role in investment decisions, often causing investors to deviate from rationality and logic. The dual system. Emotion and reason work together in investing, and understanding this interplay is essential. Emotional biases. Various cognitive biases influence our investment decisions, leading to suboptimal outcomes. 5. Cognitive biases in investing. Anchoring bias. Tendency to rely too heavily on one piece of information when making investment decisions. Confirmation bias. Seeking information that confirms our existing beliefs while disregarding contradictory evidence. Loss aversion. The fear of losses often leads to overly conservative decision-making, missing out on potential gains. Overconfidence bias. Overestimating our ability to predict market movements and making riskier investments. Herd mentality. The tendency to follow the crowd, leading to groupthink and potentially risky investment choices. 4. Fear and greed. Fear's impact. Fear can lead to panic selling, irrational decision-making, and missed investment opportunities. Greed's allure. The desire for high returns can push investors into risky investments without proper evaluation. Balancing fear and greed. Developing a balanced approach to manage fear and greed is crucial for successful investing. 3. Overcoming emotional biases. Developing self-awareness. Recognizing our emotional biases and how they influence our decisions is the first step to overcoming them. Building a disciplined investment plan. Having a well-defined investment strategy and sticking to it helps mitigate emotional decision-making. Diversification and risk management. Spreading investments across different asset classes and managing risk reduces emotional vulnerability. Long-term investing and patience. Focusing on long-term goals and maintaining a patient approach helps navigate short-term market fluctuations. Seeking professional advice. Consulting financial advisors can provide an objective perspective and guidance to counter emotional biases. 2. The role of technology in emotional investing. Behavioral finance and robo-advisors. Utilizing technology-driven tools that consider behavioral biases can help investors make more rational decisions. Emotional investing apps and tools. Applications that track and analyze emotional patterns can enhance self-awareness and improve decision-making. Automated trading and emotional detachment. Using algorithmic trading systems can eliminate emotional biases and improve investment outcomes. 1. Mindfulness and emotional intelligence in investing. The power of mindfulness. Practicing mindfulness techniques can help investors stay present, reduce emotional reactivity, and make clearer decisions. Emotional intelligence. Developing emotional intelligence skills, such as managing emotions effectively and empathizing with others, contributes to better investing decisions. Cultivating mindfulness and emotional intelligence. Incorporating mindfulness practices and self-reflection into investment routines can enhance emotional intelligence and decision-making. How understanding your emotions can make you a better investor. 4. Overconfidence. Ego. Many people overestimate their skills, whether it's changing a tire or managing their own finances. In investing, overconfidence often leads to people overestimating their understanding of the stock market or specific investments. This often results in ill-advised attempts to time the market or build concentrations in risky investments. Professional fund managers have one significant advantage. They are trained to understand the impact of biases and can attempt to mitigate the risks. That's why it's generally better to spread your investments across a wide range of expertly managed funds. 3. Letting feelings cloud your judgment. Emotion. All of us have a tendency to let our feelings color our judgments of risk and reward, and to influence our decision-making process. Basically, the mood you're in dramatically influences the way that you see the world. So, someone in a great mood might not see risk, whereas someone in a bad mood would. People often become more optimistic and self-confident when markets rise, only to descend into fear and panic when they fall. Avoiding the risk of overreacting is key to long-term investment success. The best thing an investor can do is to know themselves and be ready to manage their emotions when markets rise and fall. If you're feeling at an emotional extreme, whether it be greed, fear, or anything in between, it's probably a good idea to avoid acting on those feelings. Of course, taking personal financial advice can help you to contextualize what you're going through. Meanwhile, automating a regular monthly payment into a plan can also help to remove emotion from the investing process. 2. Reacting to short-term noise. Attention. Nothing in life is as important as you think it is while you are thinking about it, wrote the psychologist and economist Daniel Kahneman. As investors, it can be all too tempting to try to react to events as they happen. That's because our brains are hardwired to confuse how striking an event is with how likely it is to happen. For example, shark attacks capture the public imagination thanks to movies like Jaws. And yet they're extremely uncommon. More real and insidious risks, meanwhile, like heart disease or diabetes, are harder to imagine. And so we downweight them. As investors, the answer is to try and avoid reacting to short-term events. The best investors do not seek to time the market by forecasting or reacting to short-term events. Rather, they know that uncertainty is what they are being paid for, and so they adopt principles for the long term. Such an approach may lack the excitement of responding to every news headline and market turn, but it will enable you to keep your eyes focused on the horizon. Regularly meeting with a financial advisor can help you stick to those goals. 1. Playing it too safe. Conservatism. We are all hardwired for safety. It enabled our distant ancestors to survive in times when resources were scarce. Today, this conservatism could lead you to avoid less familiar investment options and taking less investment risk than you should. Over a lifetime, this could cost you thousands of pounds. Conservatism describes our asymmetrical fear of loss versus our happiness about reward. Literature suggests that people are 2.5 times more upset by a loss than they are happy about a comfortably sized gain. So, if you're a gambler, winning £100 is no big deal. But if you lose £100, you're pretty upset. We see this in the stock market too. Advisors get many more angry calls when portfolios are down 20% than they do thank you letters when portfolios are up. Staying put in an investment irrespective of how it performs can end up doing you just as much damage as not investing at all. If you continue to hold, ensure you are doing so for good reason, keeping an open mind on alternatives, and periodically review your portfolio with your financial advisor. If you'd like to know more about how to make better investment decisions, then speaking to a Street James's Place partner is a good place to start. They will help ensure that you make the right decisions to ensure your long-term financial well-being. The value of an investment with Street James's Place will be directly linked to the performance of the funds you select, and the value can therefore go down as well as up. You may get back less than you invested. Conclusion. Understanding the psychology of investing is crucial for making sound investment decisions. By recognizing the influence of emotions, being aware of cognitive biases, and implementing strategies to overcome them, investors can navigate the financial markets with greater confidence and achieve their long-term financial goals. Integrating technology, practicing mindfulness, and developing emotional intelligence all contribute to becoming a more emotionally intelligent investor. Ultimately, the key lies in finding a balance between rationality and emotions to achieve financial success. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go.